Here's a question. If you invested just $200 a month starting today and did absolutely nothing else, no stock picking, no day trading, and no checking your phone every 5 minutes, how much would you have in 30 years? The answer is close to $500,000. Not because you got lucky, not because you found some secret stock, but because of one simple force that almost nobody explains properly. And by the end of this video, you'll understand it better than most people who've been investing for a decade. This is everything you need to know to start investing, even if you've never opened a brokerage account in your life. Let's get into it. Why most people never start. Most people don't invest for one of three reasons. They think you need to be rich to start. They think it's too complicated, like you need a finance degree to understand it. Or they think investing is basically gambling, that you're one bad day away from losing everything. All three of these are myths, and all three are keeping you poor. Here's the truth. You can start investing with as little as $5. It's not complicated. You're about to understand the whole system in the next minutes. And when done correctly over a long period of time, investing is one of the least risky things you can do with your money. Keeping your money in cash while inflation quietly eats away at its value, that's actually the riskier choice. So let's destroy those myths one by one, starting with the most powerful concept in all of personal finance. The engine, compound interest. Albert Einstein reportedly called compound interest the eighth wonder of the world. Whether he actually said that or not, the math backs it up. Here's how it works. When you invest money, it earns a return. Let's say 8% a year, which is roughly the historical average of the stock market after inflation. The next year, you don't just earn 8% on your original amount. You earn 8% on your original amount plus the return you made the year before. That sounds small. It is not small. Let's say you invest $10,000 once and never add another dollar. At 8% a year, after 10 years, that's about $21,600. After 20 years, it's about $46,600. After 30 years, it's over $100,000. You didn't do anything. You didn't add a single extra dollar. The money made money, and then that money made money. Now here's the part that changes everything. Time matters more than the amount you invest. Imagine two people. Investor A puts in $300 a month starting at age 25 and stops entirely at age 35, only 10 years of contributions. Investor B waits until 35, then puts in $300 a month every single month until age 65, 30 years of contributions. Who ends up with more money at 65? Investor A, the one who invested for only 10 years and then stopped. That's the power of starting early. It's not about how much you invest. It's about how long your money has to compound. This is why the single biggest mistake people make isn't picking the wrong stock. It's waiting. So if you take away nothing else from this video, take away this. Start today, even if it's small. What investing actually means. Let's clear up what investing actually is, because the word gets thrown around loosely. Investing means putting your money into an asset with the expectation that it grows in value or generates income over time. That's it. That's the whole definition. There are a few main types of assets beginners should know. Stocks. When you buy a stock, you're buying a tiny piece of ownership in a company. If the company grows and becomes more valuable, your piece becomes more valuable too. Some companies also pay you a small portion of profits regularly. That's called a dividend. Bonds. A bond is essentially a loan. You lend money to a government or a company, and they pay you back with interest over time. Bonds are generally more stable than stocks, but they also tend to grow more slowly. Real estate. Owning property, either directly or through something called a REIT, a real estate investment trust, which lets you invest in real estate without buying an actual building. Index funds and ETFs. This is where most beginners should actually start, and we're going to spend real time on this in a minute because this is the single most important concept in this entire video. Here's the mistake almost every new investor makes. They think investing means picking individual stocks, finding the next Amazon, timing the market perfectly. That is not how most successful long-term investors actually build wealth. Let me show you what actually works. Index funds, the beginner's best friend. Imagine instead of trying to guess which single company will succeed, You could just buy a small piece of every major company at once. Apple, Microsoft, Amazon, hundreds of others, all in a single purchase. That's exactly what an index fund does. An index fund is a basket of investments that tracks a specific part of the market. The most famous example is the S&P 500, an index of 500 of the largest publicly traded companies in the United States. When you buy a single S&P 500 index fund, you instantly own a tiny sliver of all 500 of those companies. Historically, the S&P 500 has returned close to 10% per year on average before inflation over the long run, though any single year can be wildly different, including sharp drops. Some years it's up 25%, some years it's down 20%. But zoomed out over decades, the overall trend has been upward. Here's why index funds are so powerful for beginners specifically. Number 1, instant diversification. You're not betting on one company. If one company in the index fails, it barely affects you because you own hundreds of others. Number 2, low fees. Index funds are usually passively managed, meaning there's no expensive fund manager picking stocks. That keeps the fees extremely low, often a fraction of a percent per year. Number 3, it removes emotion. You're not trying to time the market or guess which stock will pop. You're simply betting on the long-term growth of the entire economy, which historically has been a very good bet. There's a saying in investing, time in the market beats timing the market. Professional fund managers, with entire teams and access to data most of us will never see, consistently struggle to beat the market average over the long run. If they can't reliably do it, trying to pick individual winning stocks as a beginner is an uphill battle. This doesn't mean individual stocks are bad. Some investors enjoy researching companies and building a portfolio around a few they believe in. But for most beginners, starting with a broad index fund is the simplest, lowest stress, historically effective path. Okay, theory is done. Let's talk about exactly how to open an account and put this into practice. Step 1. Build a small safety net first. Before investing, aim to have a small emergency fund, enough to cover a few months of essential expenses. This isn't optional. If your car breaks down and your money is tied up in the stock market, you might be forced to sell at a bad time just to cover the repair. Investing works best when you don't need to touch that money for years. Step 2. Choose the right account. If your employer offers a retirement plan with any kind of matching contribution, start there first. That match is essentially free money. Beyond that, many countries offer tax-advantaged investment accounts. These help your investments grow with reduced or deferred taxes over time. Step 3. Pick a brokerage. Choose a platform with low or no trading fees, no account minimums, and a simple interface. Step 4. Decide your contribution. You don't need thousands of dollars. Start with whatever you can and stay consistent. Step 5. Automate it. Set up an automatic recurring investment into your index fund. This strategy is called dollar cost averaging. By investing a fixed amount on a regular schedule, you avoid trying to time the market and remove emotion from the process. Step 6. Do not check it every day. Markets move up and down. If you watch your portfolio constantly, you'll be tempted to panic. Set it, automate it, and let time do the work. The mistakes that destroy beginners. Mistake 1. Trying to time the market. Mistake 2. Panic selling during a downturn. Mistake 3. Investing money you'll need soon. Mistake 4. Chasing hype and guaranteed returns. Mistake 5. Not starting at all. The person who starts investing consistently today, even with a small amount, has historically been in a much stronger position than the person who waits years for the perfect time. The best time to start is when you're ready to begin and stay consistent. Let's bring it all together. Compound interest rewards time more than it rewards the size of your contribution. Index funds give beginners instant diversification and historically solid long-term returns without needing to pick individual stocks. The actual process is simple. Build a small safety net, choose the right account, automate your contributions, and then leave it alone. Investing isn't about being a genius. It isn't about getting lucky. It's about starting early, staying consistent, and giving time the room it needs to work in your favor. If this video gave you the push to finally open that account, that's exactly what this channel is here for. Subscribe to BudgetWise for more videos that break down money in a way that actually makes sense. No jargon, No gatekeeping, just what works. And if you want the next step, how to actually pick between the different types of accounts and funds available to you, that video is coming next. See you in the next one.